I'm really excited to talk to you about a strategy that really worked for me today. I was talking to a client who owns a piece of property. They really have to move. They're going to have another child. They need an extra bedroom. They're in a quandary because their present interest rate is at 3.5%. They have a lot of equity, but they also have a lot of debt. When we started talking about how are we going to make this move happen and how are we going to make it move and make it work for them financially, they were just really stuck on the fact that their interest rate is 3.5% now, and it's probably going to be about 6.5% for a new purchase, maybe at a little bit higher purchase price. And I thought, let's talk about this. Instead of me being an app taker, let's talk about a strategy to help these clients get into another home and have them be comfortable with that. So we looked at their overall financial profile. The amount of equity they had was enormous. They actually had enough equity to put a large down payment, at least 20% or more, so they wouldn't have that monthly mortgage insurance. And we looked at the overall debt, and they had an enormous amount of credit cards. You're paying 24%. You know how hard it is to pay off credit cards. You generally are only paying the minimum payment, and those are really hard to pay off. There's an auto loan with a very large payment. If you work in our industry, you see that a lot of the debt that clients are carrying now are auto and credit cards, enormous amount of credit card debt. And so I looked at the numbers and I said, okay, let's look at this. If we take a new purchase price, put the 20% down or more, this is kind of where your payment's going to land. But let's take the rest of the equity or some of the equity and pay off this debt that's weighing you down. See, technically you're making the payment at 6.5 already anyway, and then some. And so we crunched the numbers, we looked at it. The sense of relief of not having that debt anymore was enormous. And so it brought down the stress of a higher interest rate, took them off the table. They are considering buying because alleviating that from that debt was just enormous. And so instead of me being an application taker as a loan officer, it was smart to have a conversation with the client about their overall financial profile. That's why I'm a mortgage advisor, to help the client make something make sense. We think as loan officers for the future that interest rates are going to go down. This client that's gonna buy the new house at the 6.5 most likely will refinance or have an opportunity to refinance. But it was that mental roadblock of the rate. And I think as a loan officer, it's best for us to get off that rate issue and get into overall profile, equity position, and debt issue. Clients in the United States, clients have $1 trillion in consumer debt. That's enormous. So I do feel that in the future, shortly, and as soon as interest rates start decreasing a tad, people are going to realize that they are just drowning in debt in their credit cards. It doesn't make sense to have an interest rate at 3.5 or 4.5 if you're paying 24% on just one credit card, and you have more than one credit card. So it's a great strategy. I want people to start thinking of the shift in the mindset of overall financial profile and just instead of rate. And as a loan officer, it's a great way to help our referral partners get a list and get a buy. And that's what our partnership is all about, right? So glad to have you with this tip on mortgage strategy, and I'm glad to be your loan officer of choice. If you are a home buyer, a first-time home buyer, we have many programs that can help you with the down payment. If you're trying to sell on contingency and move, I can help you with that strategy also. So remember, don't think twice about asking Kathryn, Vatsula, for home loan advice.